well, I mean, if you count grad school, it was more like 6 or 7 that I just hadn't been active. I was so caught up in doing my work and trying to prove myself and whatever. And when I did have time, I prioritized my family, not my health. And so I wasn't like overweight or anything, but I was in the worst shape of my life. I mean, the Ironman stuff is awesome. I love it. And it's, I think as individuals and as couples and families, you kind of have to decide what's most important. And, I decided that this isn't something that I can be, I'm never going to be a podium guy because I'll never prioritize this so much over my family that to be able to do that, I know how much time it takes. And so for me, it's more about achievements and competing against myself than it is competing against other people that are in the course.
Digo, esto es en inglés, ya lo vimos, es el pan. Todo ese pan es en inglés.
Sí, el pan de inglés.
Okay.
¿Y Diego, qué es este?
It's from my pelo, Dada.
Yeah.
Mama, we didn't use any today, though.
Welcome to EntreParenter, where we explore the confluence of business ownership and family nurturing. Today, my guest is Jesse Randall. He's a mid-30s father of 5 with degrees in economics, environmental law and renewable energy development, and entrepreneurial finance. He's only had about 1 regular job in the last 11 years, but he's a stellar example of someone seeking to live life on their own terms. Jesse, thank you for being here with us on EntreParenter.
Yeah, good morning. Happy to be here, Ryan.
Great. So to start out with, what came first, the family or the business life, and how did you come about choosing the entrepreneurial path?
Oh, definitely family. We started pretty early. It was my wife and I got married in our early 20s and started our family pretty quick. So we had one adventure pre-kids, but it's kind of funny you ask it like that because my first adventure with my wife, our only adventure solo, was in Europe. We went and did an internship in Brussels, and I worked for this Israeli family living in Europe that ran about 7 businesses. And that was my first touch on like true, like, I don't know if you call it lifestyle entrepreneurship, but like the kind of entrepreneurship that you are very deliberate about,
Yeah.
It was my first exposure to it, and I just fell in love with it. And it was that coupled with international business that really started sending me down the path I was on. But I'd say we started our family first. I mean, we had I guess 3 kids by the time I was officially finished with schooling, and really hit the workforce post-grad school. So
Yeah, not uncommon. So if it makes you feel any better, we finally got a real honeymoon when my wife was already 6 months pregnant with our first kid. So we started similarly early. So I hear you there. So your wife, so has she played a role in any of the businesses you've been involved in, a direct role, or is that not how you've organized things?
No, we kind of laugh about that. We've said forever that we could never actually work together. We even joke that if we'd known each other in high school, that we wouldn't have liked each other. So, life has a way of having good timing. But yeah, my wife and I operate pretty differently in that way, but we made the choice to, like, with our family setup before we were ever married, we were aligned on how we wanted to go about raising a family and dividing our roles, so to speak.
Yeah.
But so we kind of joke about that because I think my wife's personality is she likes to have a very specific scope of what she's supposed to do, very checklist oriented, right? And she likes to be held accountable to that. And so that works great in any environment as long as it's not me who's providing the checklist and the accountability. So that's why we couldn't work together, right? That's okay because we consider ourselves equals, right? So it's hard for her to imagine me in that relationship with her, right? Because we're on the same level. So we kind of joke about that. But no, like, I've always been independent in that regard. But I have to say that I couldn't have ever done any of my ventures without the support of my wife. She's incredible. And I don't think that I could have ever found any success or even been able to take a lot of these risks without her full support. So I wouldn't have done any of this stuff without her.
What were some of those conversations like? When did you recognize that for yourself, you had the risk threshold to take this path? And did she have that innately, or was that a point of negotiation between the two of you, or something that had to be grown into as a couple?
I'd say we grew into it. I mean, my wife and I have always known that we call them adventures, right? We're going to take lots of adventures together. And you know, if you were to ask my wife, one of the things she appreciates about me is it's that I do set us up for lots of different paths. Where she claims that she probably wouldn't go down those paths by herself if I wasn't the one that was kind of charging ahead, so to speak.
Sure.
But we didn't know about this entrepreneurship stuff until we'd been married for a while. You know, I came back from that European experience. I mean, this is like almost 15 years ago. And I had just fallen in love with this thing. I didn't even know what entrepreneurship was. So I worked for that family and, you know, got all this exposure doing business in all these different contexts. And I came back kind of with my own idea. I was actually working for that company, recruiting for them here in the United States when I came back. And that was my first idea to come out of that. And it was just kind of like, I didn't know what I was doing. You know, there was no lean startup. There was no methodologies out there to follow. You know, we're just kind of going. It was very, very instinctual, you know. But my wife supported me. I still remember came back from that experience, and this guy that I was working out with, lifting weights with at the time, and we had some econ classes together, and I kind of looped him in on this idea, and we started working on it. And we would meet at the library. So I was at Utah State University. We'd go meet at the library at 7 a.m. 3 days a week to work on this thing, and we would work before classes. And you know, my wife was cool with that. I think that was like the first time that I ever was like kind of sacrificing our time in order to do something businessy, you know, that wasn't a 9-to-5 kind of role, or actually making money. and from day one, she was just always so supportive. She's, you know, say, go get it, you know, and I'm here, and, you know, we'll figure stuff out. And I've never once felt resentment or, I don't know, regret or anything like that from my wife, with her allowing me to take the sacrifices to do these things.
So one of your early ventures, you kind of have listed on your LinkedIn profile as ahead of its time.
Which one was it?
I think it was a business. I think it was the one that won the business plan competition. The one before Drip Drop or Drip Drip.
Yeah.
The one before that.
Yeah, so that one.
Can you talk through that emotional roller coaster a little bit?
Oh God, so this is the fun thing about entrepreneurship. You have way more failures than you have wins, for sure. And I've had 3 really solid failures where I worked, not like an experiment where I was like dipping my toe in the water, like full on like years of work just to have it fall apart. And I mean, it is a emotional roller coaster. I'm surprised my wife still likes me, you know, after putting us through some of that stuff, because they really didn't yield anything except, you know, in many ways, you know, a lot of lost time. I mean, of course, I gained a ton of experience, but, you know, from a family economics perspective, certainly didn't yield anything that, you know, direct. So I had a few. I mean, I'll tell you about that last one. You're probably referring to one called Reveal. And that was my first attempt at a high growth startup. Like I quit my job to go after that one. And it's interesting because like I'd worked on it. Where do I start on this one? This one's interesting, like in full context, because at the time I was working for a startup accelerator. And they also had a VC fund, and I actually ran that accelerator. So I was the one that was like in charge of bringing companies through this program. And so we'd recruit and qualify companies to come in, and they're coming in from all over the country, and we put them through this programming that was 3 or 4 months long. And at the end, you have demo days and all that kind of stuff. And you know, you can only build other people's stuff for so long. That was something that I discovered about myself before you get your own thing. And after about a year of doing that, I'd run into something that I became rather passionate about. And I started working on nights and weekends. And it was interesting because I had a full-time job and I was trying to keep things very separated. You know, I felt like I was doing a good job of it, but I was getting pretty burned out. You know, I mean, I would go into work and I'd leave home at like 6:45, get to work at 7:15, 7:30. I would work until 5:30 or 6. And then I'd go and work on this stuff for 2 or 3 hours. And then I'd go home. And I was doing that probably 3 or 4 days a week, just trying to get the thing to move ahead. at one point, after about a year and a half of that, I decided to quit my job and just go for it. And it's funny because I helped all these companies, yet I made so many mistakes, just so many mistakes. And the timing for it was actually, in retrospect, the timing was really good, but my execution was really pretty bad. And I didn't even understand the systems that I was going through, which is why I always laugh when, people put so much stock into methodologies, because just because you read a book and see a methodology, doesn't mean that you can actually know how to go out and build the business. It's a totally different thing. And so I'd worked on that, and I just, in a way it was ahead of its time because companies' heads weren't there yet. It hadn't struck them how to take advantage of these things. So the company concept, very briefly, was basically back in 2013 and 2014, businesses had spent about 3 years building up their social followings on Facebook. So Facebook opened up the ability for businesses to create company pages in like 2010, 2011. And they were encouraging them to spend all this money to get followers. So you'd spend all this money to get followers, and they're building up these followings of millions of people. And then they started reducing the reach to actually put your stuff in front of them. And no one really noticed. That was the funny thing. It took about a year and a half where, at first with every post, you would reach 40 or 50% of your audience. And then pretty soon it was only 30%. And then it was only 20. And when it got down to about 15, people started noticing, because like everyone is riding the upwave so much and spending so much money to get new viewers that they didn't really notice that the reach to those viewers was dropping simultaneously. So at the end of the day, it was like you paid cash for a car, and then they were saying, now you need to rent the car from us, was basically what Facebook was telling everybody. So you're having to double pay, and everyone was livid. But what they hadn't done was they hadn't taken away the reach of an individual user. So like me or you, if we shared something, we'd still get to 40 or 50% of our friends, because if we didn't, we'd leave, right? And so the notion of this was, well, what if we just took like the top 2 or 3% of a company's followers and take them out of the platform into something that's owned by the company, and then provide content and a unique experience there that people could share back to their networks and give them exclusive content and early access to information and stuff, so that they could be kind of ahead of the curve and cool. And that when you would line up enough people to do that, you'd end up getting way more reach.
This is an influencer incubator.
It was like an early stage influencer network, right? But like micro influencers.
Yeah.
And so I had this big idea, and I just thought that businesses would be on board, right? Like, this is obvious. But as I got into it, what I realized was I was just completely underprepared for how much they didn't understand. It was really funny. I got into these big corporations and talking to people like Coca-Cola and JetBlue and like all these places, and they had no idea how social media worked. Zero. And at that level, they were basically outsourcing everything to agencies that were spending all this money to do this objective, to grow their followership, and they didn't understand, And so that's why I say it was ahead of its time, because the narrative couldn't exist yet, because there wasn't the understanding to even have it make sense. And so even though the timing was great, because if we'd been able to nail it right then, right, we really could have built something interesting. But anyway, so I ended up burning through a ton of personal resources, if we're being transparent, and I couldn't hack it anymore. And I had to go and get a different job to support my family. And that was a rough time for me personally, as the primary breadwinner, right? I mean, it's really hurts your pride. But I learned so much from that.
Yeah.
Probably more than you were asking for, but
no, that's why the channel exists. So follow up on that is, how old were your kids at the time, and what did they understand about daddy's work?
Oh my. Well, yeah, that was part of the fun is when I quit that job, we were 4 months pregnant with our fourth child. So in the middle of this, we had a baby. I mean, It was wild. It was a wild time. And so my oldest at the time was probably about 6, I think, 6 or 7, in the middle of all that. And they had no idea, 6, 4, and 2. And then we had a brand new baby a few months into it. And they didn't know what daddy was doing. I would leave the house and try to go work somewhere else, to get some space and try to get something done. But no, they had no idea. Heck, I think even now they still have no idea. They just know I lock myself in my office and I come out at night.
So after that, so you get to talk to us a little bit about, is it Drip Drop? that
Drip drip. Yeah.
Drip Drip?
Yeah.
Talk to us a little bit about Drip Drip, and then lead us into this new adventure you're on with Sweater. What
Yeah, sure.
what was Drip Drip, and how'd you get out of that? It looks like you got out of that in 2020. And
Mm.
what was the segue into Sweater from there?
Yeah. Drip drip's a funny story. So I ended up having kind of a, personal miracle in terms of getting out of Reveal, that last venture I just told you about, and into a job that I could support my family on. And people can count miracles however they want. Personally, it was amazing. I ended up getting a job in like 10 days when I had, it's one of those things where it's like I was somewhere that I wasn't really supposed to be, but I felt like I was supposed to be there. Ended up meeting a person that I wasn't supposed to meet, that ended up having lunch with me, that ended up introducing me to a job that got me a job 10 days later. Right. I mean, it was just this thing that, you can't plan that kind of stuff. And so for me, it's a miracle. And so I got into that position. I was a very valuable member of that team because of my background, and was able to make a good impact. But I had this chip on my shoulder. I mean, I had just failed like mega, at least in my mind, right? It wasn't that public, because we'd never really gotten customers and all that kind of stuff. I mean, I had failed in a big way, but I had this chip on my shoulder, and that chip was like, you tell these entrepreneurs that you can do this, like teaching them how to do it, but you can't do it yourself. You failed like this. And I mean, it was eating at me. I couldn't handle it. And so I ended up I set a personal goal. I said, if you can't figure this game out, then you're just a hypocrite. And if you're a hypocrite, then you shouldn't be working with people telling them how to run businesses. It's not what you should do. Like I even had almost like a moral thing where it's like, if I really can't do this stuff, then I shouldn't be teaching other people, right? Or trying to advise people. So for me, it was kind of a moral quandary as well as just a chip on my shoulder. And so I said, I need to go out and build something and prove that I can actually create something people want, sell it, which was a big problem that I had in the last venture, and actually fulfill it and showcase that I can do this whole spectrum and run it. And so I set this arbitrary number in my head, and I said, I've got to go sell $500,000 worth of whatever. And I got to fulfill it. I got to do it all myself. I'm not going to outsource it. I'm not going to do anything. I need to do this myself. And it was really kind of irrational, because if I'd had a different mindset, I probably could have built a pretty big agency because the timing was pretty good on it. But I had picked up kind of a skill set with the company that I was working for. I helped them raise a seed round. And they're based in Arizona and Phoenix, and I helped them raise some money. And as soon as they had the money, and of course you need to start being more aggressive with your growth. And so they were a B2B company, and I had read some stuff. I kind of had a buddy that was doing this cold outbound outreach, like sending cold emails to people. But he kind of told me about this tool that they had created, which allowed you to prospect is the nice word, professionals' email addresses. I mean, this was in 2015, early 2016, when no one was doing this. And it was pretty cool, and I started doing research, and I raised my hand inside the company and said, I can build an outbound cold lead gen machine. Let me build it. Nobody else knows how to do it. No one's ever done this stuff. Like, this is cutting edge. Let me build it. So I spent a few months, and I figured out how to do it, and had a really good machine for targeting who you want to get in front of, running this prospecting mechanism to do it in a scalable way, and then managing outreach to try to start conversations with people who were a good target buyer, right? And so I kind of figured this system out, and I was like, hey, this might be the thing, right? Like, I can go do this, and I could see how I could sell it like this and this and this. And I had been interacting with a lot of agencies and seeing how much they were charging, and I decided to go for it. So I parted ways with that company, amicably, and said, I need to go do this. And we're still friends. Matter of fact, that company ended up getting sold to Fiverr about 2 years ago, which is kind of cool. But I ended up staying friends with them, and I said, I need to go and do this thing. So I ended up landing a couple of clients from sort of quasi friends that gave me the runway to go and do it, which is a different story, which is actually kind of cool. And then I started operating, and it took me about 2.5 years to finally hit those revenue numbers and make that whole thing happen. And then I hit that, and then I was kind of at a loss because I hit the goal. But I was so set on this arbitrary thing that I hadn't been laying the groundwork for something bigger. And frankly, by the time I was 2.5, 3 years into that, that whole space had become very saturated. And I found that while it was great money, I was not passionate about generating leads. It was not what I wanted to do. And I didn't care enough about money to really pursue it permanently, you know?
Mhm. Yeah.
And so I was immediately at a loss. And now, you know, I have this business and I'm making money and my family's great. I have tons of flexibility. I mean, I can go anywhere I want. I can work from anywhere. I'd started doing Ironman training right towards the beginning of this. So I was like really into training. You know, I'd go on long rides in the middle of the day and, you know, train for all these events and stuff. And so I had all these things, right? But I still was just kind of like, I don't want to do this for 10 more years. Like, I don't think I even want to try to scale this and sell it because I can see where this industry is going. It's getting too saturated. Like if I wanted to sell it, I should have sold it a year ago. Like I should have built it into something that I could have sold and sold it a year ago, but I'm way past that. So
Sure.
what do I want to do with this? You know? And that's where like, I was starting to kind of ache for something else. And I always knew that I wanted to do something in software again. I think it goes back to that chip on my shoulder. It's like, okay, I did the thing, right? I proved that I can survive and do this on my own. And so you need to go back and you need to find something that's going to take care of that other chip, which is building a scalable company and doing it again. And if there was one thing I learned in all of that, it's that timing is everything. You know, you can't buy timing. As in my last venture, I was just too early from a market understanding perspective. And I recognize that now. I was just too far ahead of the curve. And so I started working and kind of waiting. You know, I was observing. I was just waiting for the right opportunity. Interestingly, this is a super long answer, by the way, sorry. But interestingly, somebody tapped me on the shoulder and said, hey, we should build a venture fund in Phoenix because the Phoenix capital ecosystem is pretty bland. You know, there's a couple of VC funds, but they really don't invest locally. They don't move money early. There's a couple of angel groups and they're great. They put capital in the ecosystem, but they're kind of old school. They're definitely lagging several years behind other ecosystems in terms of their valuation and forward thinking and being forward thinking and all that kind of stuff. So they have a very specific taste that they like, right? And I'd seen plenty of ideas come and go inside the Phoenix ecosystem that weren't well supported. And I thought, you know, like maybe there's something here, maybe we could really build a fund. And so I kind of took the bait and we started going down this path. And that's how I ran into this concept for Sweater. So when I was at that accelerator, they had raised a venture fund when I was there. I actually created the initial pitch decks and, you know, with their investment thesis and all this other stuff and watched them as they built that. And so I was familiar with the process and I knew how hard it was, which is why I hesitated when the guy was trying to get me to come in on this with him. And immediately, the thing that we ran into was this accredited and qualified investor requirement.
Yeah.
And I knew that before, right? I mean, I watched them build this other one. I knew that you had to be able to write big checks and all that kind of stuff. But what really got me was I realized that I didn't qualify to put money into my own fund.
Yeah.
And I was like, wait a minute, how messed up is this? I've been doing this for 8 years. Like I know startups pretty well. I understand this risk, you know, like I have a master's in entrepreneurial finance. Like I get the risk, like, you know, I've taken worse risks, but I can't put money into a fund. Like this is kind of silly. And it went from a curiosity to becoming a very deep passion of like understanding why. And that's how Sweater was born. So Sweater's whole concept is to have to be a venture fund that anyone can put money into. You know, instead of a $500,000 check, let people put a $500 check in and then manage it accordingly and make investments into venture quality companies or venture qualified companies the same way that a traditional VC fund would do. And that's where I got started into this. And that's its own roller coaster. It's been almost 3 years since I started that path, but I'll breathe for a second and see if you have other questions.
So I'm excited to get in the nitty gritty about Sweater, but let's go back to your Ironman training and work-life balance, family balance. How many hours did you train a week?
Oh.
And how did you do it? I guess is my question. Being the owner and proprietor and getting that balance, was that well, let me ask this. Did you feel like that was sustainable at any level? Like could you do
work-life balance thing?
Well, specifically during your triathlon training or endeavors, could you do 2 or 3 triathlons a year? Or is that?
Oh yeah, you definitely can. Oh yeah. Oh yeah. I mean, like that's a thing that I discovered. I mean, that's got its own story. Like I had just decided to go out. Well, it was in that window when I was deciding if I was going to leave that kind of savior job I got and start Drip Drip. It was in this window, and someone challenged me to do a triathlon, a sprint triathlon, and it was kind of one of those pride moments where it was like, well, of course I could do that. I mean, like in high school, I played sports. I played football and basketball and whatever, but like I never ran. I like, you chase a ball. You don't just run, like that was my mentality. And
See, I did cross
there's no
country,
ball
and so I
involved.
was.
Okay, so you get it. But like I'd never done that before. I'd never trained for long distance. I'd done track a couple of times, but I did sprints and long jump and stuff. I didn't do the long distance thing. And I'd never ridden a bike more than like, around the block to go to the grocery store and get some candy. And swimming to me was like splashing in a pool or playing basketball in a pool. I'd never swam laps ever. And when he challenged me, he kind of had this look in his eye. I went to church with this guy, and he kind of had this look in his eye, like, I don't think you can do it. And I just my pride was like, well, of course I'll do it, right? And got me into this thing. And I was in this spot where I had been working my tail off for probably 4 years, and I probably, well, I mean, if you count grad school, it was more like 6 or 7, that I just hadn't been active. I was so caught up in doing my work and trying to prove myself and whatever. And when I did have time, I prioritized my family, not my health. And so I wasn't like overweight or anything, but I was in the worst shape of my life. I mean, just from an overall fitness perspective. And anyway, so this guy challenged me to do this, and I was like, yeah, I got it. And I had like, I don't know, 2 or 3 months to get prepared for this. And
That
I still
doesn't seem
remember
like
doing
enough
that.
time.
Yeah, well, it was a sprint, right? Sprint is
So what? Tell me, what's the difference?
you-
What's a sprint
Okay, so
version of a
sprint, and then it moves its way up to an Ironman, right? So a sprint is the shortest one. Usually swim like 400 meters. You'll bike maybe 12 to 15 miles. There's some flexibility depending on the course parameters. And then you'll run a 5K. So it's supposed to take you about an hour, hour and 15 minutes, hour and a half, depending on how fast you are. And so I remember thinking, oh, yeah, I got this. It's no big deal. But from there, so it goes from a sprint to an Olympic, which is double all those distances. So usually swim more like 1,200 to 1,800 yards. And then you are biking 26 to 28 miles. And then you're running a 10K, right? And then you've got a half Ironman, which is double all of that again, mostly, right? So you're swimming like 2,400 yards. You're biking 56 miles. And then you're running a half marathon, 13 miles. And then you've got a full Ironman, which is double that again. So you're swimming 2.4 miles, which is like 4,200, 4,400 yards. You're biking 112, and then you're running a marathon, 26.2. So I started at the base level, right? And, my buddy challenged me to do this, and I'm like, oh, I got it. And I thought that was pretty well prepared, but I didn't know anything about training and nutrition, and I didn't know anything, right? So I go and show up for this thing, and I got my butt kicked, like in a big way. And I still remember just looking around and seeing, being beat by all these old guys and, these teenagers and stuff. And I crossed that finish line. And as soon as I crossed the finish line, I was like, I am doing that again. Like I was so upset with how terribly I did that, but it was addicting. That was the funny thing. So that's how I got into it. And I went and did the same race 3 months later, and I cut like 25 minutes off my time, which was absurd, right? But I got a real bike, because I did the first one on a mountain bike. And so I got a real road bike, and had a bunch of guys challenge me to do a century ride, which was way over my head. I had no idea what I was getting into. It totally destroyed me, but it gave me a base. And, we could talk about endurance training all day, but like the notion of having a base is like getting your body to a certain level of fitness that just kind of always stays at. And you'll go up and down, but you'll always come down and land on your base. And before this experience, I didn't have a base, so I was trying to build it. And there were things that got me up to actually having a base. And then from there, it was just all uphill, right? And one of the reasons people hate running and cycling and swimming and stuff is because you don't have a base. And so the process of breaking through it and creating one is really, really hard. But once you're through it, then you're kind of golden, and you can kind of go and do anything you want, and you understand your body better and all that kind of stuff. But to your question about sustainability, right, and being able to do all that while having a life and running a business and all that kind of stuff, it's totally doable. It's all about priorities, and I have strong reasons for having that be a priority for me. Both my grandpas died in their early 50s from heart attacks, right? Separate gene pools, both died from heart attacks. Who got all those gene pools? I did, right? And I've got a few brothers, and we're all very aware of what could happen to us if we don't take care of ourselves. And my wife, of course, is aligned with that. She doesn't want me to die when I'm 52. And so we decided this was going to be a priority, and that, you know, I don't have to do crazy extreme stuff all the time, but my fitness level, you know, is something that is important to our family and our longevity of our family. So like mixing all that into life is important, but at the end of the day, you just kind of figure out how to make it work. And for us, you know, it's basically like, as long as I have my workouts done before 7 a.m., then it doesn't matter. And if I try to squeeze stuff in the middle of the day or late in the day and that sort of stuff, then my training is terrible. And then I have bad experience in races and stuff like that. And it's not worth it, you know? So it ultimately comes down to my discipline to go to bed early, wake up really early, get that stuff done, and having a good cadence. But at the same time, it's like all that it's to me what creates for a very fulfilling life, because by having that cadence and that requirements that you're always getting done, it reflects in everything else you do. So I worked my way up to doing a half Ironman, did several halves, did lots of other endurance events, running events and stuff. But I wanted to get to doing a full Ironman. And we had a baby one year. We had our 5th child the year that I thought I was going to do it. So I put it off, because the training regimen for a full Iron, like you can go do a half Ironman with like, you know, probably like 3, 4, 5 months of training if you already have a base, which I did. So I did a bunch of those. And then we had our 5th child, and I was like, I really want to do this because I have a feeling that life is just going to get more crazy as our kids get older, and I just want to get this done. So I put together a plan where I was going to basically build up to doing a full Ironman in a calendar year. So I signed up for 3 half Ironmans, all spaced a couple of months apart, leading up to doing a full Ironman that I was going to do in Italy. And so I had this plan. I was like, I know exactly what I have to do. I understand my body. I've already done 3 or 4 half Ironmans. I've run across the Grand Canyon a couple of times. I've done all these things. Like I know how my body works, and I'm going to go and kill it on this race. And I had this perfect plan, and I wanted to break 11 hours, which is really fast. That would have put me in like the 85th percentile, you know, in terms of like getting through it. And I was like, I can do this. I know that I can. And I had this perfect plan. And about 4 months into it, we decided to move to Colorado, and it totally upended everything. But I ended up, so I still went through with the plan, but my training was just terrible. So I did my first Ironman on more of a survival basis, and my goal dropped from 11 hours to, well, maybe I should just break 12 hours to maybe I just need to make sure I finish the race, right? And I kind of devolved, but I still did great. I finished at about 12:45, which is still great, you know, no complaints. But
certainly the high Colorado air, the elevation helped you at some level.
So, oh yeah, you would think so, right? But anyway, so that was that.
Sure. Yeah, that's my experience. Certainly has shown, and other entrepreneurs I've interacted with, is if you have a family, you have to make hard decisions, and one single result can't be the result that dictates everything else, unless you're prepared for serious compromise of other things in life.
Mm-hmm.
Yeah.
So, well, and I agree with that, you know, I mean, but it's funny when you examine those priorities, right, and making sacrifices and stuff, because at the same time, like at least my combination of, you know, being a family guy, being entrepreneurial, and liking to do this endurance training stuff, you know, it's a different recipe. You know, there's 100 ways to make chocolate chip cookies, you know, and this is our way of making chocolate chip cookies, and the combination works for us, right? Maybe it's not chocolate chip, maybe it's like, you know, oatmeal raisin, but you know, someone that's making chocolate chip cookies is going to say, man, oatmeal raisin cookies are disgusting. Why would you do that? Like, well, for us, this is what works. And, you know, we feel we found that balance, even though some people don't understand it.
Sure. Why don't you continue on with Sweater? So it's a new VC funding concept. What does the public need to know about it? As far as how is Sweater going to change the game?
Right. Well, I mean, so here's the quick context for it, right? So if you want to put money into a VC fund today, right? Let's even go back a little bit further. So why would you even want to put money into a VC fund, right? I mean, VC funds access the highest quality, highest potential companies, private companies in the world, right? when you look at the S&P 500, it's ridiculous. It's like 40% of the companies on the S&P 500 started out as private venture-backed companies that became public and created all this value, right? Like the top, I think it's like 8 out of the top 10 companies on the S&P 500 are venture-backed, right?
Mhm.
They've created a tremendous amount of value in the world. But as individual people, we only get to benefit from that once they go public. And that's when we can start playing in the game. So, you take a company like Airbnb, right? So Airbnb goes public for $20 billion or whatever, right? That whole $20 billion worth of value, none of that value was captured by the public. It was all captured by private investors and venture capital. They made investments and created that value, right? And then, if they go from being worth 20 billion to 40 billion, that's great. But that's the same as going from 10 billion to 20 billion. Like what's it like to go from 10 million to 20 billion? You're talking about hundreds of times of value growth, right? And all of that is being captured by private markets. And it's getting worse, so to speak, right? There's a trend where private companies are staying private longer and longer and longer. If you look, 10, 12 years ago, companies would go public, when they were worth 300 or $500 million, right? And then as the public, we would benefit from that growth from 500 million to a billion to 10 billion, right? And we benefit from all that. But now there's this whole new funding category in venture called growth capital, which is now taking companies that would have gone public and saying, just stay private a little longer, right? And they give them huge checks, hundreds of millions of dollars to sustain themselves for longer periods of time and to soak up even more of that value, that initial value. And so is that good for the public? No, it's really not, right? It's a complete lost opportunity, and the game is being played by venture capitalists that have a lot of money. And frankly, and I'm not the only one talking about this situation, right? Like Jay Clayton, the former SEC chairman, has been talking about this for years. And, the whole thing is, how do we get the public into private assets in a safe way, right?
Well, sorry to interrupt, but what you just described, it seems that is evidence that all of the investment options the poor public has access to, they're not good enough.
Yeah,
right. The people that have the capital that's sitting on the sidelines, it's not deployed elsewhere because none of the other options, stocks are largely overvalued now and have been for a long time. So yeah, you can get in that, but it's risky for that reason. Interest rates are zero. You can't lend it for anything. So right. If you have the kind of capital to play in the VC realm, then you can own that market, which to your point is, stealing's a strong word, but capturing it and sequestering it in more of a oligarchical sort of way, right?
Yeah, it's very true. We talk about the wealth gap and the increasing wealth gap and everything. Like, I'm a big believer in a rising tide lifts all boats, right? The wealth gap, may be getting wider over time, but everyone's also going up over time, right? I'm a big believer in that, and I'm a firm capitalist. Like, I believe it's lifted more people out of poverty than any other type of organizational system in the history of mankind. I'm definitely a capitalist, but it has its downsides, right? And so when we talk about something like the wealth gap, to me, it makes all the sense in the world. Besides the wealthy having more assets to deploy and make money off of money, right? Which most people don't, because we're using the money we make to survive for the most part, right? So we have a very small percentage that can actually grow wealth. There's that element, but then there's this whole other element, which is not only that, but they also get into all these assets that can be life-changing, and we can't, So it's like, well, I understand the notion of the regulations that prevent it, right? Because at the end of the day, like the 1940 Investment Act, it was made after the Great Depression to protect, as they say, widows and orphans, right? They don't want someone going down the street and knocking on your door and saying, hey, Mrs. Smith, you're 77 years old. You should invest your retirement into this new fund I have. And then they move their money and the person disappears and grandma's left with nothing, right? That's what it's meant to protect from. But the unintended consequence is that it's actually locked people out from high performing assets that are very well understood now, right? After 30 or 40 years of being around, but that you can't get into. And so if you want to put your money into a VC fund, there are economics involved that prevent small checks, and there are also regulations involved that prevent small checks. So like if you want a venture fund, so if you put yourself in the seat of a fund manager for a venture capital fund, they have to create some very big wins in order for the risk profile to work for their investors, which means they really have to be able to create a portfolio of 20 to 30 companies that are very highly curated, that are high growth, that match all these criteria in order for them to make it work. So they have to have a certain amount of money inside their coffers in order to be able to make a difference in the companies to help them be successful to get the outcomes they need, right? So you can't have like $1 million and create a venture fund and get it to work, because you can't create the outcomes necessary for the whole thing to work, right? So from a venture fund manager's perspective, you've really got to create, you know, a $20-30 million fund in order for it to work, right? So you've got this constraint that automatically says you need to raise 20 or $30 million on the very low end. Like most venture funds are 75, 100 to $300 million. Many are in the billions, right? But even like to just get a fund started, you've got to be inside this realm. And then, so then the constraint there is, well, why don't you just go raise it from, you know, a $20 million fund, $2,000 from 10,000 people, and you'll get, you know, $20 million. But there are restrictions on how many investors you can have in a venture fund. So you start putting all those pieces together, and all of a sudden, you know, my minimum check size is $500,000 in order for me to get the fund size I need in order to create the outcomes that are necessary for this asset class. And so it automatically cuts people out. Even if you were accredited or qualified, if you wanted to write a $25,000 check into a venture fund, you really can't. It just doesn't work, because the fund managers don't want to take your money because it dilutes everyone else that they're working with. So it just cuts everybody out. If you can't cut a $500,000 check, which means, you know, you probably need to have a net worth of at least 10, 15, 20 million in order to put $500,000 into a single asset. You have to have a pretty good net worth. And so most people
Jesse,
just can't do that.
for the benefits of the viewers, can you just give the definition of an accredited investor so that they understand
Yes, of course,
what that hurdle is?
So there's two levels of investor that you'll hear people talk about inside this world. There's accredited and there's qualified. So an accredited investor is usually an individual. And the qualification to become that is you have to have made at least $200,000 a year as a salary, or, you know, other income for at least 2 years, and be reasonably confident that you are going to continue that into the future. Or you have to have $1 million or more of net assets outside the value of your home. So you can't count your home equity. So if you meet one of those two criteria, then you're an accredited investor. A qualified investor or a qualified buyer is usually an entity, and that entity has to have at least $5 million of liquid assets to deploy or invest. So like an individual company, you know, that's doing 10 million a year in revenue may qualify as a qualified buyer and make investments into other fund structures. So qualified buyers are usually funds, but it can be individual companies. So even people that are making a couple $100,000 a year, even $400,000, $500,000 a year, they may not be able to have enough liquid assets to cut a $500,000 check unless they're, you know, 10 or 15 years into their cycle of making $400,000 a year. You know, it's just really hard to do that. So, you know, you run the math backwards, and it's like 99.8% of households in the US cannot put money into a venture fund. And it's like, oh, okay, well, that's the way the math works. Now, the big question is why? And it doesn't need to be that way anymore. And that was my big question. And so I'm a very curious person, right? And I started asking why, right? So I'm starting a venture fund and I can't put money into my own fund. Why? Okay, well, I have to be accredited or qualified. Okay, well, why did that start? Like, who made that rule, right? You start following the money trail back and the conversation trail to figure out what the foundation is for all this. And our big, you know, assertion at the end of it all was, well, you know, I understand there's all these restrictions and stuff with venture capital funds, but is there a different fund structure we could use that allows us to take money from the retail public and invest like a venture fund, but not be a venture fund? Is there a way to do this? And we got some clues and some indicators that, yeah, there's something out there. And we started pursuing it. And that was 2.5 years ago. And just in November, we got the SEC green light for a fund structure that will allow us to do this and to take money from the retail public and invest just like a venture capital fund so that we can move money alongside all the big guys. So that's like the kind of, you know, boring part of the story, but we're here.
Wow. So some of the questions I have regarding this is some of it's micro, some of it's macro. Do you see Sweater having multiple funds of its own, or is Sweater going to act as a qualified investor on its own with the big boys in the early days? Have you mapped that out?
Oh, 100%, and 100 different ways. There's the whole concept of crawl, walk, run, right? So we'll start off with a single fund. But I can't get into what it's called and all that kind of stuff, but I can talk about a few parameters. So one thing is that this fund will allow us to do is to take money into it for as long as we ever want. So a typical VC fund has a fixed amount. It's like they're going to raise $100 million and that's it. So if I'm an investor and I put in $1 million, I have a 1% right to whatever happens to anything inside that $100 million, right? So if they make it into $1 billion fund, then that means I just got $10 million back, right? In that case, but it's a fixed amount. Once that 100 million is filled, then it's filled and that's it. They're not going to take any more. But our structure is different. We can actually take money into it for as long as we want. So if we want it to be 100 million or a billion or 100 billion, we could do that and just grow it forever. So that also changes the portfolio dynamics of how we curate underneath. Because in a traditional fund, that $100 million fund is going to go and curate 20 or 30 really good investments, right? And they've got a very narrow thesis to say, we invest in this stage of company, in this very industry, in this very geography, and this is what we specialize in. That's all we're going to do. We're going to be ultra specialized.
And the elephant lurking is the liquidity event, right? The horizon is 7 years, 9 years. We're supposed to be done and out, right?
Yeah. Well, in a traditional fund, it's more like 10 to 14. Like it's pretty long. You start getting payouts along the way, so as they invest in companies and the companies mature, you're going to have companies that get purchased and acquired, and that money comes back and you'll start getting payouts. But the funds usually don't close for 10 to 14 years, so you're stuck in that for a long time. Yeah. And that's another big difference between what we're doing. So we can take money forever, right? But then there's also liquidity built into it. And I guess I can't get too deep into that, but basically you're not going to be locked up for 10 years inside Sweater's fund structure. If you needed to buy a house and you're like, hey, I need $10,000 out of my Sweater account, you can go and request that money and take it out when you need to. And we'll release more details on how that works, but you won't be locked up for a decade. So to your specific question about will we have multiple funds and all that kind of stuff, eventually, yeah. So I mean, this first fund is going to be focused on early stage technology companies because it's what we know. There's the most options out there for us to do that. And we can create a very strong network of partner venture capital funds that we can invest alongside. So there are a lot of elements that lead us to that, but eventually we could have many funds for people to invest in, right? So they have early stage tech. We could have a late stage technology fund. We could have a clean tech fund. We could have a biotech fund. We could have debt lending. We could do all kinds of things. And those are all individual funds that could exist underneath the Sweater experience. Mm-hmm. So when you come into Sweater, right, you could say, well, I want to allocate 20% to early stage and 30% to late stage and 20% to the debt fund over here, right? And you can start moving your money. But I mean, we're talking about years in the making to get to those kinds of infrastructural parameters.
So that'll probably be down the road. One question I've had as I've looked at this, okay, if you're going to cater to retail investors with Wall Street bets in the news and that dynamic there, and the current political climate, I can very easily see there because Sweater will be facing the public at large, right? And advertising itself to the public at large, relatively speaking, right? Within the financial services industry. Some activism is going to come along somewhere at some point in time. It sounds like maybe you can mitigate that through offering multiple funds, but VCs don't care because the uber wealthy, it's a very, very, very tight-knit group. And money's the main goal, but I could very easily see there's plenty of retail investors that have the funds that are also on a mission to do something with those. And do you anticipate any, handling the dynamics of that customer interaction? Because suddenly, VCs don't really have a branding problem. They're all considered more or less the same. They have maybe some unique attributes within the partnerships that provide advantages. But when you're facing the public and giving them an opportunity to push their money into your fund, more or less, you're going to have a branding opportunity, let's say. And some people may want to brand you for you or against your will. Have you thought through those decision trees of,
100%.
we're going to look at these types of companies, but not these ones, or we're going to look at both of them and tell people to shut up, or we'll say, okay, well, if there's 200 people asking for this fund, maybe we'll just make a fund just for you guys, squeaky wheels and all that.
Right. Oh yeah. I mean, managing the expectations of retail investors is going to be super important. And out of the gates, we have tailwinds behind us that are very much to our advantage, right? So I guess I could take a few different angles there. Let me first say, kind of how we're going to position ourselves alongside other VCs. So, and why the retail public, we believe, will align with us in our mission, right? Traditional VCs, like take Andreessen Horowitz, right, or Sequoia, right? Pretty big funds, they're enormous funds, very successful, awesome track records, invest in the best companies in the world. They have no reason at all to change their ways, to try to open up a retail arm to what they do. Like, it's just not what they do, right? They've got a line 10 miles long from every, wealth fund and family office on the planet trying to put money into their funds because they're so good at what they do. They don't need any more money, and they don't want, managing the retail public is not a core competency. They don't need to go there, right? But they have the same problem that the hedge funds have from the whole Wall Street bet situation, right? And that the Wall Street bets crew couldn't put money into these hedge funds, right? And they kind of took it to them. They were definitely in their crosshairs. And it's only a matter of time until the venture community is also in the crosshairs, right? But they have no motivation to change their ways. And this is where Sweater is
and to date,
no credible
threat, right? No credible threat to date.
Yeah. Well, they've had threats for other reasons, like having not enough female GPs and investors in the space, right? It's predominantly white male, which I'm not helping that at all. Or investing in minority-owned businesses, things like that, right? I mean, they've been in the spotlight for some negative stuff and taken a lot of heat for it. This particular one hasn't gotten there yet, but it's going to come. I mean, that this whole Wall Street bet situation has created this very keen awareness in the public that there's really two games going on, right? And there's this game that has these rules, and then there's the rules, the scraps that are given to us. And eventually this comes around, right? So it's either going to come to the VC community organically, or we're going to bring it and say, hey, we've got a solution. So, we open this up so retail public can put their money into our fund, but then we become an ally to the funds that are already out there, right? We can go to them and say, hey, you're not going to change your ways. You don't want to manage the retail public. So why don't you do this? Why don't you allow us to invest in the deals that you have alongside you? Why don't you allow us to be an investor in your fund? And then we'll take advantage of every investment you ever do. And then you can raise your white flag of benevolence and say, hey, we're doing everything we can to provide equal access to the public so that they can win here too, right? We want to be the good guy. And, all the feedback that we've received is that there will be resistance at the highest levels, right? That they don't really want to have to manage that. But here's the thing: is once one of them tips over and says,
they may not have a choice.
Everybody's got to do it, because they're not going to die on that hill, right? Yeah. I mean, Sequoia's going to be like, no way, I'm never letting retail money in. Go get in line with everybody else, with the Saudis and all the other wealthy people in the world. No way, they're not going to die on that hill. So it's just a matter of time, right? Like, we've already got several funds that have aligned with us, and we'll launch with probably 15 or 20 funds that we hit the market with that we'll be investing alongside, and we'll continue to grow that network. So that's how we get into venture quality deals, right? Is by investing alongside them. So in terms of us managing the retail public, we feel like we're very much able to play the good guy role, and that, we're managing them to get them in, right? And will they have requests and complaints about how we invest and the deals that we decide to put money into? Yes, undoubtedly, right? I mean, any fund is going to have that problem, whether it's in the private market or the public sector, right? There's going to be plenty of people who aren't keen on some of the investments we make. But then that's just the nature of this thing, right? And we're making sure that we have resources around the table to be able to manage that correctly. But then that's part of the reason that I didn't really say this earlier, but we're delivering this as a mobile app. So it's kind of Robinhood experience, but for private companies. So you can manage your investments and do all that kind of stuff and see what's happening. But then we also report on all the portfolio companies. We provide regular updates on, we made an investment in this company and this is why, right? And we're able to give them that experience, and be able to proactively engage them rather than sit back and hope they don't ask any questions, right? That's definitely not our approach. Like, I'm a big believer in radical transparency to the degree that it's appropriate, and really just giving them tons of information. And then by doing that, right, it's like the feedback we've received from everyday people is that this is as much about being entertained as it is about making money. So it's like, this is the way that we explain it, right? It's as if everyone has only ever watched the NBA on TV. Like, only the wealthy could ever go to the stadium, right? Everyone else has been watching at home on TV. And our proposition is, we want to take you to the stadium. We want to give you courtside seats, and we're going to tell you you're a part owner in this team that's playing, right? There's more of a feeling to that than there is just
Right.
the fact that you're a part owner in the team, right? And so when we talk about it, it's like, yeah, we want you to have front row seats for the whole venture ecosystem, right? And we want, if someone puts in $10,000 into our fund, it's not going to make them a millionaire. That's not the way funds work, right? I mean, we could take their $10,000 and turn it into 30,000 or 40,000 over a decade, but they're not going to come out the other end like filthy rich. That's not the way this works. So what else is the motivation for them being here, right? I mean, there's equality, there's, equal access, there's wealth gap, there's these, kind of financial contributors, but then there's this whole other side, which is this fascination with building companies. I mean, just look at how many people watch Shark Tank, right? And it's like, well, how do you give people that experience of watching a company go from an idea to, a little startup to becoming something that changes the world? And do they want to have a front row seat to watch that whole thing? And all the feedback we've gotten is, heck yeah, I want to be there for that.
So Google kind of famously, their founders famously used their clout as a very coveted startup to force two rival VC firms who had personal differences and refused to speak to each other. They forced them to partner on the deal simply because they could, because Google had already established itself as having that sort of traction. It was so every year there's at least one company, right, that has that level of clout, or maybe close to it, where everybody wants to be the lead. I can see Sweater's model being kind of the polar ends of that for many founders, where maybe they're excited about the democratization and playing in that pool, playing that game and being part of that ecosystem. And I can see others who are like, I prefer to let's just stay as private as possible and quiet as possible and deal with as few people as possible and grow the traditional way. So I can see that catching startups and getting startups to be excited about Sweater as an investor could be a toss-up, so to speak. What can you say about that? And what can you say about 5 years from now when Sweater's rolling in money put to you through your investors, right?
Right.
That could be a tremendous amount of money. What will that do to the VC ecosystem? Potentially open doors to companies that maybe would have been shut out otherwise. But there's a lot of companies that should not get VC funding for all sorts of reasons. Are valuations going to go through the roof? How competitive is bidding going to be when you democratize this and you bring in the thousands of dollars from the masses instead of the millions from the few, but which still adds up to a very large number of investable income?
Yeah.
You could turn the whole thing upside down. Right? Potentially,
yeah. I mean, and your head is moving in the right direction, right? In terms of what could be possible. We try to keep a level head about, being reasonable, and like, we're going to have to fight to create this. There's going to be lots of competition and resistance and everything else, right? And that's just the nature of building a new company, right? And so we don't underestimate what it's going to be, but we also have to examine like the potential upside upside scenario, if you want to call it that, is it could get very intense. There's a ton of retail money out there. lots and lots. And this is a hot category that people can't get into, right? So there's a chance that this could happen very fast. You know, in terms of positioning, we look at it and say, you know, we're not here to disrupt venture, right? That's not our core purpose. You know, we're not here saying venture capital is bad and terrible and whatever else, like, and we're here to change it. Like, that's not our mission. But our mission is, you know, we look at it and say venture, frankly, just hasn't reached its full potential. You know, if you rated the effectiveness of venture capital on a scale of 1 to 10 in terms of what's possible, I would put it at like a 3 or 4 or a 5, because it's it's extraordinarily difficult to break into. It's very inefficient. It wastes tons of time for founders. But if you can get into the right circles, it's great, right? But you have to work your way in, and it cuts lots of people out. So we look at it and say, well, we want to make it a 10. And you know what's missing? Retail money and retail engagement. You know, like, having more money around the table is great. It's great for founders, right? It can create more competition. There's more money in venture than there's ever been. You know, so if you can get into the right places and you have the right equation, you're not going to have a hard time raising money inside the venture community right now, because there's just tons of money. So our money, yes, it's more money, but we're not going to change the game because of more money, right? There's already plenty of money out there, and we would have to have inordinate amounts of money to make a dent in what's going on, right? In terms of changing the money flow of the ecosystem. But what we can change is the way that companies are taken to market. And this is where I get really passionate. I mean, I've had plenty of ventures that haven't made it. You know, I'm the guy that grew up on a farm outside of Jackson Hole that has, you know, no family resources, no nothing, right? And I'm trying to build companies. Like, I don't have an advantage of a rich uncle that could throw down the first $100,000 to help me build my software MVP and get it off the ground. I don't have that, right? My constraints are very different than many other people who do find success. And when you really start examining, not all of them, but you start examining lots of people, and they, you know, founders who have found success in the venture ecosystem, and they often, more often than not, have some interesting advantage from a resources perspective that allow them to advance through there. Yeah. So when I look at it, I say, well, you know, we have a way to shift the way this works, and we call it creating a new gravity point in the ecosystem. Because right now it's all very cutthroat. Like, to your point earlier about those two funds that didn't like each other, there's reasons they didn't like each other, because they cut each other out of deals. They want to take as much of these companies as possible, and they find one that's going to be hot, you know, and they're pretty vicious between themselves. And that's not the way that I want to see the world, right? I think that there's a better way that's more geared towards the founders than it is geared towards the venture capitalists, because the VC ecosystem is driven by the funds. It's not driven by the ventures for the most part,
right?
Unless you're the 1%, yeah. Unless you're the 1% that is truly the super hot deal, you know, then yeah, you've got every resource at your fingertips. But everybody else, you're basically beggars, and I don't think it needs to be that way, right? So, like, to open your eyes on kind of the way we look at this, you know. Let's say we get 500,000 retail investors who are supporting us, right? We're not just going to send them a quarterly update and say, hey, we invest in this new company, come back next quarter, right? We're going to engage them. I mean, every company you see out there, it finds success because there are people that buy products, that talk about products, that champion products inside companies. You know, it's all people behind every decision and every company that ends up bringing something new to the market. It's people on the other side of the equation that are buying that and making it successful. So part of the technology we're going to build is actually the ability to engage with those 500,000 people, that army behind us, and help companies actually get into market in a different way, right? So,
it's not unlike Kickstarter, right? It's not unlike Kickstarter, but the Kickstarter contributors are baked into your model, and they're motivated. Yeah. They're motivated by more than just the whimsical interest that the Kickstarter folks are.
I'm a part owner in this, right? So buy the product if it's interesting. Go share it with your friends. Talk about how cool it is that you're a part owner in this company. Like, there's a company here in Denver called Sheets and Giggles. They make eucalyptus bed sheets, right? And they're blowing up right now. They're doing awesome. So if we made an investment in them, we turn around and be like, hey, who needs new bed sheets, right? Does anybody work at Bed Bath & Beyond that could champion the product and maybe get it on the shelves? Like, you know, and you start having this conversation with people. And it's our objective to understand everything about all of our investors, right? Understand what their interests are personally, what they do as hobbies, where they live, what they do professionally, right? So when we have companies coming through in front of us, we can be very surgical about how we split those groups up and ask them for very specific things. So when I talk about making them, putting them courtside seats, this is really where it's at. We want them to actually engage and be a part of this. And when you can engage, just like Wall Street bets, you engage and organize at scale, and we can fundamentally change the way that companies are created, right? And how they're taken to market. You reduce risk, you give them more revenue faster, you increase their trajectory. All of these things are good indicators to be able to bring in the rest of the venture community. And so we have to build our way to get there, right? It takes time for us to get to that point. But we're not going to come out and just like smash the industry in the nose on our first month in the market, right? But 5 years in and 500,000 or 1 million people behind us, and a VC network of hundreds of VCs that align with us and that want to be able to open the venture ecosystem to the public and make room for us in their deals, it changes the way things work.
That could be a huge competitive advantage in obtaining deals directly from founders, for courting founders. Interesting.
Yeah. I mean, you put yourself in the founder's shoes and it's like green money, green money, green money, green money, but that one's got something different behind the scenes.
And it doesn't matter B2B or B2C. Everybody that's giving you money, they've got a job. And they have influence at some level within their employer and or certainly over their personal consumer dollars.
Yeah, I mean, if we were looking at, I don't know, I always use this one, but like some, med tech software for primary care physicians, right? So we turn around, I've actually got a friend that has a company that services this market. So it's like, well, okay, we're thinking about making an investment here. So we go into our database of investors and go, boop, boop, boop. It looks like we've got 7,235 primary care physicians in our network. Why don't we ask them what they think about this problem? And we have an organized, scientific way of being able to extract some information from them. This actually looks like a really interesting opportunity. Okay, let's make the investment. And now we turn around, and speaking of my background at Drip and doing cold outbound email, right?
Yeah.
The whole technique is managing communication at scale so it feels like it's one-on-one. And so part of what we'll build in is the ability for us to create that list of 7,200 doctors and go to these new founders that we just invested in. And we're not just going to send a blast in one email to 7,200 people, right? We're going to put them in a line and we're going to say, hey, founders, we're going to make 100 introductions a week. And you're going to get a steady 100 intros a week for the next 18 months. So get ready, make sure you have someone that's full-time that can actually manage all those leads, and let's go after it, right? And all these people have, all those doctors have a real reason to engage with you because they've already indicated that they're interested in this and that this is a problem. And plus they're an investor, right? And
right.
it changes the way that you do that, right? And our technology will help facilitate that kind of personalized experience, both for the founders as well as for our investors inside Sweater, so that they feel like they're really making a difference, right? And having that experience.
That's awesome. Excited for you.
We could talk about this all day. We got to go out and build it, right? But we're close. So I mean, like we're raising a pre-seed round right now for the fintech company, not inside the actual fund, and we're going to market really hard and fast. So it's exciting. Hopefully, we have this out and ready later this year, maybe early next year, and we'll get this in the public's hands as soon as we can.
If you can answer for me, how'd you go about choosing Chad? Or, well, tell us how you chose Chad. I got two questions for you.
Well,
and this is in the context of this channel is for people that they are on the cusp, either on the cusp of starting a business or they are in the thick of it. And in my MBA program, where I specialize in entrepreneurship, there is a professor who I never met, but the legend goes that one of his favorite sayings is that partners in business are terrible, because partners in business, it's like being in a marriage, but there's no sex to break the tension. so that was his advice. Now,
that's fair.
So choosing a someone to go in with at whatever level of participation is not a decision to be taken lightly. So presumably you've had enough experience in the past to approach this thoughtfully, and how did you settle on bringing him in?
Well, I in different scenarios, I tried doing things alone, and it's a lonely road. It's really hard to do it alone.
Yeah.
I would differentiate between a partnership agreement and a co-founder. Like, and then differentiate between a high growth business and what I call cash flowing businesses. So, cash flowing business could be owning, a network of, plumbing services, right? It says something very specific, can spin out a ton of cash, but it's never going to be $1 billion business, right? And it's not going to grow like that. It's based on services, whatever, right? So there's all kinds of businesses that fit in this category. They're great businesses, can really change your life and give you great outcomes. And I call them cash flow businesses. So having a straight partnership agreement in a cash flowing business, I think is very difficult, right? They're usually not set up right. 50-50 splits create all kinds of problems, right? I mean, it's very difficult, I think, in that situation, especially once it starts creating money. And then you've got this whole other problem, right? So I tend to agree in that scenario. But in high growth startups, it's a little bit different because typically what you're doing is so hard, and it's a lonely path, right? It's a lonely path, and it's fraught with all kinds of unique risks. I mean, like, it's the difference between walking through a forest in North America and walking through a jungle in the Amazon, right? There are so many more things that are going to kill you in the jungle. Yeah. And it's kind of like that, right? And everything's unmapped, right? So it's difficult to do that by yourself. I mean, there are notable exceptions when you look at like Jeff Bezos and some others, right? But most have a team around them when you go do that. And some of that is just plain experience, right? To be able to see things that you don't see, right? If you've been attacked by a jaguar in the jungle before, you're going to know what to look for, right? And if anything else, you can at least stand back to back and you get twice the coverage. And so in startups, I think that teams are just extraordinarily important. High growth startups, teams are extraordinarily important. And Chad is awesome. I asked Chad to come on this after we'd known each other for about 1.5 years, and he'd been helping from an advisory perspective. But it's interesting because I guess I can put this out there. Chad wasn't my first co-founder. I've actually worked through a couple of different co-founders until I got to Chad. And because this was a long path. I mean, I told you I've been doing this for 2.5 years. Yeah. And it's hard to hang on for that long, and to prioritize something like this that's not creating any money over other things that could be creating inordinate amounts of money, right? And trying to balance them both. And that was one thing that I learned how to do, is how to survive, right? How to create revenue on my own so I can survive as with me and my family, and still do something that's not creating any value in the world yet, right? Or at least not any revenue. And so I knew how to do that. And I had a founder that couldn't pull that off, and we had to part ways. And I had another founder who was making so much money at a very reputable, well-known technology company in Silicon Valley that I can't talk about, I shouldn't mention, but he was making so much money that he couldn't pull himself away from it to focus on this. And so I ended up parting ways 2 different times with 2 different, very talented people in their own right, that, for different reasons, couldn't hang on. And so I met Chad. I actually moved here from Arizona because I wanted to build this company here. And Chad was helpful. He actually engaged, and he was consistent. He had value to add. He brought valuable people to the table that I never could have met. And he plugged me into networks and helped give me credibility that I couldn't create on my own, while being an awesome person, right? And understanding the space as well. So there are a lot of reasons that I brought Chad in, but after having gone through a couple of co-founders, I was also very wary about getting into another relationship, so to speak, Yeah. And so, I mean, Chad will say this too, that, I did my homework before I extended an invitation to him. And I was very thorough about understanding his background and all that kind of stuff, and his character before bringing him in. And I'm super glad I did. I couldn't imagine having anybody else other than Chad in with me at this point in the game. And he's a fantastic co-founder, so we'll be able to, we complement each other's skills rather well. And we'll be able to build a great company together.
Sounds great. So what are your parting words? What is your sage wisdom for those that are pursuing the entrepreneurial path, specifically with those that have family concerns?
Rule number 1, figure out how to survive 100%. If you can't survive financially and from a stress perspective, emotional perspective, all that kind of stuff, you've got to figure out how to survive, because you are going to get beat up. You're not going to make money as fast as you want to. And when it does come, it won't be as much as you want to. Everything will take twice as long, cost twice as much, which will put twice as much or 4 times as much pressure on your marriage and your home situation. And so you need to be aware and not be wearing rose-colored glasses about the path that you're about to take. And so that takes just looking yourself in the mirror and having some really good conversations with your spouse to understand and level set on what's coming. And as part of that, you also need to learn how to survive. So survival can come from all kinds of things, right? I mean, you could look at it and say, well, I've got $100,000 in the bank that's going to cover, my $7,000, $10,000 monthly burn I have with my family or whatever, right? That's just going to cover things as if they're normal. And I know it's going to take me for this long, right? It could be that, right? It could be, I know that I can use 20% of my time consulting to generate revenue that is going to cover my nut for this amount of time. And I know that I have this starting and I can continue to do this, and I'll dedicate the other amount of my time to the venture, right? It could be all kinds of things, right? I mean, it could be just hitting the ground running with the venture and doing services instead of, trying to build a product out of the gates, and building a company on top of a different foundation in order to get there. I know several founders that have done it that way. But at the end of the day, you got to survive. I mean, the more that I am in this community and watch those that are successful, it's those that could just hang on longer are the ones that made it more than anything else. Like going back to my social media thing that I was doing with Reveal.
Yeah.
I stopped that, not because it wasn't a good idea, but because I couldn't hack it anymore. I wasn't generating revenue. I was running out of money. I had a family to feed. And when I took that job, I put it on the shelf saying, I'm going to come back to this. And I never did because I couldn't, So I think survival is number one, right? You figure that out, know your plan and know how to survive, and make sure that you have enough time carved out that you can still do the thing that you're really passionate about, right? And understand that dichotomy. If you can survive and hang on long enough, you can create anything, right? And part of creating anything may mean making some changes in your plans as you learn about what you're creating, right? But if you set yourself on that path, you will lead yourself to something that's good. It may not be everything that you dreamed or planned from the beginning, but you can create something that is wonderful, right? And so if you have that passion inside of you, you can absolutely do it, but you've got to learn how to survive. So I'd say that's thing number one, especially if you have a family, right? It is your primary responsibility to make sure they're taken care of first, and that your spouse, whatever the situation is, that they're on board with it. Like Chad's situation is very different than mine. My wife is home full time with our 5 kids. And we've been doing that since we were married, right? Since we first had our child and our first kid. And that's our situation. Chad's situation is different, right? His wife is a doctor. And so they have a very different notion of risk taking and what it means for him to be involved in things and making money and surviving, right? So everyone's got a different equation, and there's not a wrong one. You just, have to understand in your situation what's best for us and making sure you're on board with that. And then on top of that, right, if you've got other people you're working with in the venture, I find it best to just be transparent, not about how much you are making or whatever, right? But like how you're going to do it. Because if somebody cuts out after 6 months because they can't hack it and you didn't know, that's just a disruption to the thing you're trying to create. So I think that there needs to be transparency and all that with the team that you're building it with and everything. So there's that. But then the other thing is just freaking do it. Get off the fence, figure out the plan to survive and just start, because it will never all line up. Nothing will be perfect. You're never going to have enough money in the bank, right? You're never going to have perfect timing in between the stuff with your kids. You're never going to have that perfect amount of experience or the right relationships or the technology built before you do it. I mean, none of it will ever line up. And if you're waiting for that, it's never going to happen, or it's going to happen in a way that isn't going to work, right? So at the end of the day, it's you grinding through whatever it's going to be and having the wherewithal to be able to push through it and figure it out. Because it's never going to be perfect. You're always going to have some shortcoming somewhere, somehow. So if you have a survival mentality and the just get out and frickin' do something mentality, I really think that entrepreneurs can do anything. But people get caught up in those two things, or they have poor expectations around one side or the other, and it ends up messing stuff up, So yeah, I mean, to me, that's the two big things. I mean, there's all kinds of elements around how you build companies and products and business models and like all that kind of stuff. And frankly, you just got to figure that out. There is no formula to creating a company. Most of it is just being smart, being diligent, being able to survive long enough to make it happen, and really being smart enough to identify the paths you need to go down. And frankly, some startups won't make it because the founders make crappy decisions. right? And that's just part of it,
That's-
you know, and they will fail. Like, I mean, you track everything back to why a startup failed, and almost guaranteed it all comes back to the founders and whether or not what they're working on is a good idea, basically, right? I mean, you look at these lists that come out, you know, it's like, these are the top 10 reasons that startups fail, right? It's like, no product market fit, ran out of money, whatever. You track that back, ask why a couple of times on every one of those. You know what the answer is every time? Founders. Founders made poor decisions. Founders didn't identify a need that was good enough. Founders couldn't look themselves in the mirror and say, I need to try something a little different here. The founder couldn't survive long enough financially to make this happen. The founders made lots of stupid decisions and burned all the investor money instead of, you know, getting the company to the milestones that it needed to, right? I mean, every single one, it comes back to the founders and how the founders act, right? And ultimately, at the end of any venture, it's the founders. And so, you know, it's not like that needs to be a pressure point, but it also needs to be understood that like no one is stopping your progress or your success except for yourself. And you have to understand that, you know, and it takes a certain amount of, like, I'm blessed with this inordinate amount of, I think Clifton Strengths Finder calls it self-assurance, right? I think that's a nice way of saying that I'm an arrogant son of a gun, right?
Yeah.
But like, I have this innate confidence in my ability to do things. And part of that, you know, that evolution over my life is that I'm not always right. And I have an assurance that when I'm not right, I am smart enough to be able to move away from it and do what is, right? And it takes time to look yourself in the eyes and have that conversation with yourself. And sometimes, you know, you have to move on to something else. But anyways, maybe that's a little doom and gloom. But at the end of the day, you know, I really think that, you know, founders are very capable. And the thing that makes founders weak is when they're not willing to adjust their plans and learn from what they're figuring out. And to me, that's just self-awareness.
What I found when I was starting our company was the liberating aspect of poverty, in that if you have nothing to lose, you can do anything. You can take almost any step if you have nothing to lose. And so to your point of start now, find a way to get going, because if your idea will go nowhere if you don't actually take the first step. And a lot of people are afraid of those hard conversations you talk about because they're terrified of losing the golden handcuffs. They have some level of comfort and they don't want that to go away.
Yeah.
You know, but if you never get comfortable, then you can
No,
just
I think
forge it.
there's so much truth to that. You know, I mean, the golden handcuffs are real, man. I've got some friends that are making great money in the corporate world, and man, they can't even imagine coming over and living the life that I've been living. You know, like I kind of laugh. You know, our retirement plan is very different than the typical financial path that they tell you about in school. You know, I mean,
Yeah.
for us, I mean, effectively, we're betting on entrepreneurship. You know, and it's like, I'm 37. Like, if my first 3 ventures didn't get me much, right? Sweater looks very promising. Maybe it won't get me much, right? I got a lot of runway left before I'm 60. And I already know that, like, I could go out, like, I know how to leverage money and investors and relationships to go and buy businesses. Like, if I wanted to, I could go and buy 5, you know, plumbing businesses and wrap them up under a brand and go create a cash flowing entity that I sell to a PE fund one day. I can totally do that. It's not what I'm doing right now, but it's like, well, my backup plan is very different. You know, I could go and do that when I'm 48 or 55 or whatever, right? And roll that out and be fine.
Right.
But it's not the game I'm playing right now. You know, I lovingly refer to traditional retirement plans as squirreling away money, which maybe, I don't want that to be condescending, but to me, it kind of is. It's like, I'm taking all my all my nuts and I'm going to go put them in a tree and I'm going to save them there and not touch it. You know, and to me, it's like, no, I got this nut, man, I'm going to go figure out how to make peanut butter out of it. And I'm going to go sell it to people. And it's going to create, you know, 100 trees full of nuts of, you know, value. And that's the way that I view the world, you know? So it's like, yeah, I got to survive and make this whole thing work, but I'm betting in a different way. And, you know, if you have the mentality that, you know, you need to have that kind of financial security and that consistency, you're going to have a hard time being an entrepreneur because there is no consistency. Matter of fact, you're going to take every nut you ever put in that tree and you're going to shove it back into this thing. And if you don't have the resolve to do it, then, you know, there's a good chance you're going to get to a decision point where It's like, you're either going to do that or the thing's going to fail.
I'm going to chop
And
the
you're
tree
gonna have
down and use
this-
it as firewood.
Yeah, yeah, exactly. It's like, are you going to do it or not? Right. And you're going to have to make that call. And if you don't have the mentality to be willing to do that, then you're just going to get caught in a bad situation, and you're just going to leave it with regret and go back to your golden handcuffs and go back to squirreling away money. And you'll just be mad that you wasted 5 years of squirreling on this thing that didn't work. When in my mind, it's like, well, were you ever committed in the first place? Right? Were you really willing to do what it takes? And it's hard. That's a hard question.
And the worst thing, so on that note, the worst thing about the government options of squirreling away money, right? You talk about your IRAs and your 401ks, and I chafed at that when I was working for others. I used it, but I chafed at it because I knew my perspective was, if I'm putting money in public stocks, that's just me investing in somebody else's dream.
Yeah.
That's not me investing in me. And frankly, I want to bet on me. And that's your choice. And they screw you over. I mean, it's a different discussion for a different channel, but why why does the government need to threaten you with a 10% penalty on a 401k withdrawal because you want to invest in yourself? It's all about control. So thank you, Jesse, so much for this time and for your wisdom. And it's great to hear about Sweater. Wish you the best of luck.
Well, thank you. Yeah. Feel free to join the wait list.
I have already. I have joined the wait list already, people, and you should too.
All right.
Sweaterventures.com,
yes.
right?
That is what it is. Yeah. It's coming along nicely. There are exciting things on the horizon for Sweater. We're very, very excited to bring it to the world.
Right. Well, thank you so much for your time.